It is June 27th. I want to talk to you about a very busy week in the headlines, and there's certainly a lot to talk about. I am focusing purely on economics, investing, and central banking. There's certainly a lot more to talk about that really goes beyond the scope of what we do here every week. I want to talk about, is there a housing bust coming? Could we see a gas tax holiday? Contrary to what many officials may say, the recession is now here. I want to do a bit of a stock analysis. There may be an eviction wave coming and Florida rents jump. So let's talk about, first of all, the housing bust that I have been talking about is coming. I think we're starting to see signs of that now. This is a headline. The world's bubbliest housing markets are flashing warning signs. Global monetary tightening. Let me put that another way. The slowing of currency creation is squeezing home buyers, adding risks that a slowdown could ripple through the economy. A world economy already contending with raging inflation, stock market turmoil, and a grueling war is facing yet another threat, the unraveling of a massive housing boom. Central banks around the globe are increasing interest rates, albeit they are doing so at a pace that I believe will not significantly alter the trajectory of inflation. However, what is happening is borrowing costs are going up. For example, if you are buying a house at the beginning of the year with good credit, you could have a 30-year mortgage with an interest rate of 2.75%. It's now over 6%. You're seeing soaring interest rates now affect housing in Canada, the United States, and New Zealand, and markets are slowing very, very quickly. I talked a bit here about where mortgage rates have gone, so I'm not going to go there again, but we've got central banks now very concerned about inflation. However, as interest rates now go up very nominally, I would argue, we are seeing markets now react very negatively. It's a repeat of 2018 when the Fed began to tighten and other central banks began to tighten, but I believe it's going to be more significant. We're already seeing the diminishing wealth effect from the stock market declining literally 25%. We are in an official bear market. I've got a stock update for you here momentarily. Real estate prices will simply add to that effect. Consumers will become less confident, and certainly it's taking a lot of potential housing buyers out of the buyer pool. Rob Subaraman, who is the head of global markets research at Nomura Holdings, said this: a decade of quantitative easing, put another way, a decade of currency creation, has fueled frothy housing markets, and we could be entering the other side of this soon as housing affordability is stretched and debt service ratios could rise very sharply. Such a scenario would gum up bank lending. We're already seeing that. Lenders are becoming more cautious. Borrowers are dropping out of the buying pool simply because interest rates have made them not qualify for a certain level of payment based on their income. So whenever you see credit slow, keep in mind that expanding credit, expanding currency creation is the fuel that drives or builds a debt bubble. Once that fuel is removed or begins to be removed, then you start to see a reversal. And we've seen that reversal in stocks. I think we're now going to see it in housing. Now, there is talk in Washington of a gas tax holiday. This, an article by Gabe Ferris titled, Biden may soon back a gas tax holiday, plus rebate cards to address the pain at the pump. Experts say the move, which would require Congress to take action, would lower gas prices by between 14 and 15 cents. Top White House officials keep putting forth the narrative that tackling high inflation remains a chief priority. However, there's some question as to how to do that. Now, there is talk. Biden said that he would make a decision as soon as this week. on whether to support a pause in charging the federal gas tax. That would lower prices by about 15 cents a gallon. Treasury Secretary Janet Yellen said the administration is open to that. She said that gas prices have risen a great deal. It's clearly burdening households. So the president stands ready to work with Congress, and gas tax holidays are certainly an idea that's worth considering. But Jennifer Granholm, for those of us who live in Michigan are familiar with Jennifer Granholm, she is now the energy secretary and a former governor of the state of Michigan. She disagreed a bit with Yellen. She said on CNN, quote, "Part of the challenge with the gas tax, of course, is that it funds the roads. We just did a big infrastructure bill to help fund the roads. So if we do, and if we remove the gas tax, that takes away the funding that was just passed by Congress to be able to do that. That's one of the challenges, but Granholm said, I'm not saying this is off the table." Nancy Pelosi said, I'm a bit of a skeptic. It's probably better PR than it is policy. Biden also suggested, not surprisingly, that gas rebate cards were also under deliberation. Keep in mind that the only policy response left is creating currency. And as the last couple of years have passed, we see that that currency creation has really become helicopter money. So I look as we move closer to the midterm elections to see more stimulus. Gas rebate cards could certainly fit into that category. I think we'll see the Fed reverse policy and go back to quantitative easing, and I would not be surprised. It would be disturbing, but I would not be surprised to see price controls. It's unclear, the article writer said, as to how gas rebate cards would work. Would they be preloaded, or would you get a rebate after you purchase the fuel? Administration officials are putting forth the narrative that a recession is not inevitable. Biden said there's nothing inevitable about a recession, even though I believe that the evidence overwhelmingly says we are in a recession. Of course, you would expect that they would put forth that talking point. That's a terrific segue into this article published by Graham Summers. And the title of the article is "Forget the Forecast, the U.S. is already in a recession." The U.S. is in recession. A recession is not coming, according to Summers. It is already here. I know it, and you know it. Just look around you. Yes, restaurants and airports are packed, but demand for both dining out and travel are pent up after 2 years of lockdowns. These parts of the economy don't represent real demand. They represent people desperate to return to some semblance of normalcy, and they're burning through their savings and racking up credit card debt to do so. We've talked about that here on the Headline Roundup broadcast. Pointed out several weeks ago that credit card debt in the U.S. has doubled, and the personal savings rate has gone from 34% at the time of massive government stimulus now to just barely positive. Walmart is the largest retailer in the United States. Summers very convincingly argues that Walmart is in many ways the U.S. economy. It's the largest private employer, and it's a large retailer. But take a look at Walmart stock. You see that there's an uptrend line drawn on the chart beginning in early 2016 and continuing through the beginning of this year. You now see that rather significant uptrend lasting almost 6 years has now been broken to the downside. Amazon is the largest online retailer. You see this uptrend line began really mid-2015, a bit earlier than the Walmart uptrend line. And now you see that that uptrend line has also been broken to the downside. Summers says the U.S. is already in recession. I completely agree. The people trying to predict it in the future are ignoring the clear and obvious signs right in front of them. The recession has already arrived. In fact, it's been here for some time because of, in a word, inflation. Same point that I have made. my numbers would say 71% of gross domestic product is consumer spending. Summers says it's 75%. Regardless, more than 70% of the U.S. economy is what you and I go out and spend. And a little common sense applied has one asking the question, if you can't buy food and gasoline, then what else are you going to be able to buy? And the answer is nothing. And that is going to drive the recession in this economy that is so heavily dependent upon consumer spending. Stefan Gleason said the economy is headed for a hard landing. I completely agree. After months of ignoring the steadily growing inflation problem, the Federal Reserve is now using monetary blunt force to try to rein in rising prices. I would argue that the Fed's policy is not monetary blunt force. I think that the Fed is trying to make it look like they're going to engineer a soft landing, avoiding recession and getting inflation under control. However, the monetary blunt force that would be needed, similar to the monetary blunt force used by Paul Volcker in 1980, would be to raise interest rates to a very high level to get inflation under control. They're not doing that. So the Fed, understanding the economy is going to slow down, is going to try to get inflation under control gradually. I believe this will be impossible for them to do. Now, the article writer said the recent carnage in the stock market suggests that the Fed's suddenly aggressive rate hikes are going to crimp consumer borrowing and hurt retail sales. Stocks, which are now fully in bear market territory, tend to lead the economy. The message of the stock market is very clearly that recession is coming. The claims to the contrary by Biden administration officials are less than convincing, especially given their track record of failing to recognize the inflation problem until it became too overwhelming to deny. And as we've discussed, the narrative on inflation has changed a lot. Started out by saying inflation was going to be transitory. It's moving back to an open economy after the lockdowns. Then we went to persistent inflation. Then the narrative went to uncomfortably high inflation. So the narrative has changed, and the track record by the Fed and the administration is not great. Janet Yellen said, I don't think a recession is inevitable. Of course, that's what she has to say. But when you take a look at what is actually going on in the economy, we are really, I believe, in recession. And the Atlanta Fed, as I pointed out last week, did amend for the fourth time second quarter GDP numbers to zero, which would put us in a technical recession. The economy now faces a reckoning over supply and demand imbalances. The housing market faces a reckoning after the fastest rise in mortgage rates since 1987. That, as we've discussed already on today's webinar, I believe will have the housing market mimicking the stock market here in the very near future. I would guess before this year is over. Sellers of houses are now being forced to negotiate prices down so buyers can afford the monthly payments. Meanwhile, housing starts, home construction permits, and mortgage applications are now falling rapidly. That will affect housing in just a few months. There are other danger signs for the economy. I already mentioned the Atlanta Federal Reserve Bank's GDP Now tracker shows economic growth coming in at 0% this spring. The Philadelphia Fed Business Index turned negative for the month of June. That hasn't happened since the COVID lockdowns. Social mood is collapsing. The latest University of Michigan survey of consumers shows that consumer sentiment is now at a record low, lower than it was at the time of the lockdowns. A recent survey found that small business owners are feeling the gloomiest in nearly 5 decades. 5 decades takes you all the way back to when the dollar became a fiat currency. And 59% of U.S. manufacturers now believe that a recession is coming. Now, as it relates to stocks, this is a chart of an exchange traded fund that tracks the S&P 500. If you look at the top left-hand side of the chart, you see the symbol is IVV. Now on this chart, which is a weekly chart, each of the bars on the chart represent a week's price action. The green bars represent weeks that the market went up. The red bars represent weeks that the market went down. Now I have drawn two trend lines, two downtrend lines on the chart. The first began at the end of 2021 and goes to the present. So you see this starts really about a third of the way from the right of the chart and slopes down to the right-hand side of the chart. It's the shallower sloping line. There's another one that starts in about April of this year that is a steeper sloping line. You see that these two trend lines show that we could have a 4% rally to get back to the steeper trend line and an 11% rally to get back to the shallower trend line. I believe that stocks could rally here by up to 11% and we would still be in a bear market. Now, the recent rebound in stocks last week, I suggested was likely for two reasons. And I suggested this in the June 20 issue of Portfolio Watch. One, you see that the second bar from the right-hand side of the chart is a red bar, and you see that the price gapped down. Gaps down are almost always filled with a gap back up. And the other thing you see on the chart is a blue line and a red line. And this blue line and red line really kind of incorporate all the price action is between the two lines. However, if you take a look at last week, you see the market closed below that red line. Well, if you look very closely at the center of the chart, there's a very faint gray line. That faint gray line is a 20-week moving average of price. The blue line and the red line represent two standard deviations from the difference between the closing price and the average price. So whenever you get price movement outside two standard deviations, there's a price extreme, and we often see a rally, and that's exactly what happened last week. Now the question is, will we see another rally going into this next week? Well, I think a lot of it depends on what happens geopolitically, but I wanted you guys to understand that we could really have a rally of up to 11% before this downtrend would be broken. So a number of the pundits last week were saying stocks are recovering. We're going to go back to a bull market. I think that this chart really illustrates that we are a long way from that. And I wanted you guys to know, again, you can have up to an 11% rally, and we are still officially in a bear market by my measure.
Dennis, we have a question on that topic.
Yes, go ahead, Mark. Thanks for catching it.
No problem. The question comes from Dave. Do you have an S&P level where you would start to buy in? I've seen bank forecasts of 2,800 to 3,200.
Well, this IVV, you can see the current price is about 39.20. I think there is an old cliche here, Dave, that I would probably bring up. That cliche is you don't ever want to try to catch a falling knife. So I'm going to want to wait for a good uptrend to appear before I jump in and buy. There is an indicator called a MACD and another indicator called stochastic that when used together on a weekly chart can be pretty effective to predict uptrends. Those are both still downtrending. So I would be looking for an uptrend based on some reliable indicators. So I wouldn't necessarily have a number target in mind. I think that's dangerous. This chart really bottoms out at about 2,800. So, I mean, should we get to that point, you would see a drop from here of about 30% from these levels. I mean, at that point, I think you would certainly expect that an uptrend might emerge. but I would wait for it to emerge rather than predicting at this point that it would emerge at a certain level as noted by a number. So I hope that answers the question.
Jeff has a follow-up question to that. Is this an example of a chart showing Bollinger Bands? And if so, how do you use a chart like this?
Well, yes, Bollinger Bands, Jeff, represent the blue squiggly line at the top of the price action and the red squiggly line at the bottom of the price action. Squiggly line is not a technical term. It's a term I'm using to describe what you see on the chart. So Bollinger Bands can be used a number of different ways. I like to use Bollinger Bands just to help me recognize price extremes. Whenever you see 100% of price action on a weekly basis outside 2 standard deviations, that's a pretty good indicator that prices have reached an extreme, and we're likely going to see a bit of either a bounce or a decline, depending on whether they're at the low end of the Bollinger Band or the high end. Doesn't mean that it's a trend change. It just illustrates extreme conditions in the market. So there are trading systems built around Bollinger Bands. You can use different standard deviations. This happens to be a 2 standard deviation Bollinger Band. I use 2 standard deviations just to recognize price extremes, and I'm looking for 100% of the activity to be outside the Bollinger Band, either on the top side or the downside. So that's how I use them. I don't use them as a primary indicator. I use them as a confirming indicator. So hope that answers your question.
That's all the questions we got for the moment.
Thanks, Mark. Yeah, and just as a side note, if you guys appreciate the analysis, appreciate the charts, just let me know. I'm happy to incorporate more of this into what we talk about every week. I know we risk going down a road here that many of you consider to be maybe a little bit too technical, a little bit too geeky, but for those of you that give me that feedback, I'm happy to share with you some of the analysis that we're doing on a regular basis. And the short-term price moves we talk about in our positions newsletter for those that subscribe have pretty much been on target this year. So I expect from this point that we could see a bit of a rally here. Doesn't have to happen, but prices are still at a pretty extreme level, despite the fact that we saw 5 and 6% moves in the Dow and the S&P last week. This is from that positions newsletter. That's a perfect segue. Last week I said there's no way to describe stocks price action last week other than ugly. Sectors that were holding up broke down. Energy stocks have fallen nearly 17% this month. Stocks are oversold here, and a bear market bounce from here would not be surprising. That is exactly what happened. This week I suggested that prices are not at such an extreme level, but seeing some consolidation here and some additional bounce would not be surprising. This is from Zero Hedge. The headline is, prepare for a tidal wave of evictions. As often happens whenever you have a government policy like eviction moratoriums, whenever the moratorium is lifted, what would have happened happens anyway, and it actually happens more intensely. So that's exactly what I believe we're going to see here as far as evictions go. The article says a tidal wave of evictions could be ahead. More than 8 million Americans are behind on rent payments. 8 million Americans. And the CDC's series of eviction moratoriums has long since expired. In other words, the government safety net to keep people off the streets is gone. There's no federal eviction moratorium in place, so there are 15% of all renters who are behind on rent and who are at risk of being evicted. 3.5 million households were somewhat likely to leave their rented spaces within the next 2 months because of an eviction. Now, if you notice, of the 3.5 million, nearly half of them make less than $25,000 a year. And then if you take a look at the number of the 3.5 million that make less than $35,000 a year, you're really at about 2.4 million of the 3.5 million. You see the breakdown on that chart by income. Part of the reason of this for this is that you're seeing the cost of food and fuel go up, and it's putting the squeeze on people's ability to pay their rent. We've also seen rents increase. I have friends and family members who live in metro areas, and we have seen huge rent increases in those areas for very, very small apartments. 6.7 million households said their rents increased on average by $250 a month over the last year. Well, that doesn't sound like a lot, but when you combine it with rising gas prices, rising fuel prices, the fact that many have credit cards maxed out and no savings, it now becomes a very big problem. We now see that we are moving into stagflation and recession, and this will likely get worse before it gets better. And then finally, Miami housing rents jumped 41% in April, year over year. That's remarkable when you think about it. Nationally, single-family rent growth surged 14% year over year in April. That's according to CoreLogic, which is a real estate research firm. Among large cities, Miami recorded a 41% increase year over year. Miami rents were 41% higher on average in April of 2022 as compared to April of 2021. The second largest increase was Orlando. So you see you have Miami, Orlando, Phoenix, San Diego, Las Vegas as the top 5. New York City, DC, St. Louis, Philly, and Honolulu make out the top 10. Miami and Orlando are both located in Florida. They had the largest rental price gains out of all U.S. cities. The reason is supply shortages because people are moving to Florida from New York, from Massachusetts. The article writer said New Yorkers are still panic exiting the state of New York and ending up in Florida. The Wall Street Journal recently noted that Miami locals are irritated by New Yorkers flooding their most desirable neighborhoods like Brickell, Edgewater, and downtown, driving up rents. So that's what I have to talk about this week. Again, apologize very much for the technical issues. Not sure what happened, but Mark is going to sort it out for us. Hopefully we will have a better experience for you next week. Again, we apologize. And Mark, as I kind of finish up here, are there any additional questions that maybe we need to address?
No additional questions, but we will not be here next week.
You know what? It's the 4th. It's the 4th of July. I don't think we want to be here next week. So we'll be here in 2 weeks on July 11th. So thank you for that clarification also, Mark. You guys have a great 4th of July weekend. We will see you in a couple weeks. Thanks for participating. Thanks for getting the word out too, guys. Appreciate it.